What if the biggest risk in your portfolio isn't a market crash, but the very companies everyone believes are unstoppable? Right now, the biggest names in the S&P 500 are spending hundreds of billions of dollars on AI. But here's the question. Almost nobody is asking, what happens if all that spending doesn't turn into cash? Before you buy another share of the S&P 500 or QQQ, you should understand what's changing. Most investors believe they're diversified, but in reality, a large portion of their money is concentrated in a handful of mega-cap tech companies like Apple, Microsoft, Nvidia, Amazon, and Alphabet. These companies have delivered incredible returns, but they're also investing record amounts in AI infrastructure, putting pressure on their free cash flow. And free cash flow matters because it's the money companies use to buy back stock, pay dividends, reduce debt, and fund future growth without relying on outside financing. That's why more investors are paying attention to an ETF called VFLO, which focuses on companies with strong free cash flow today and the potential to generate even more in the future instead of simply buying the biggest companies by market value. The goal isn't to chase hype, it's to own businesses that consistently generate real cash. Historically, this strategy has produced strong returns while experiencing smaller drawdowns during market volatility. Of course, no ETF is perfect. VFLO owns fewer companies than the S&P 500, making it more concentrated. But it also follows a completely different investment approach. So, here's my question for you. Would you rather own the biggest companies or the strongest cash-generating companies? Let me know in the comments. And if you enjoy straightforward investing videos backed by real data instead of hype, hit the subscribe button. I'll see you in the next one.